Speculators increased their bullish commodity wagers for the first time since November as signs of accelerating growth in China and the US drove prices higher. Joining me down the line to discuss the performance of precious metals edging into 2013 is Tom Kendall from Credit Suisse. Now Tom, demand for palladium is exceeding supply for a second consecutive year. Some analysts believe consumption will continue to beat production until around 2017, but what are your expectations moving forward?
Yes, we tend to agree with the consensus that the fundamentals of supply and demand for palladium are painting a positive picture over the medium to long term. It's a metal where supply is relatively constrained, and we see demand rising, particularly in catalyst to control automobile emissions in emerging markets particularly. But in the shorter term, it's clearly become a favorite of a certain sector of the hedge fund and investor community. It's been so for some time, and the market positioning is already quite long, and that's via futures, options, as well as physical exposure directly and through ETFs. So in the short term, that makes us a little bit cautious on price. It's already come off around 4% year to date, and we think that could pull back further. We published an updated commodity price forecast last week, and our average target for palladium this year is $725 an ounce. So a little bit above where spot is currently trading in the mid-600s.
According to analysts, gold prices are likely to remain trapped in a range over the next few weeks as investors remain cautious. But what would you say are the main factors affecting sentiment at present?
Gold is very highly attuned to what is happening in the United States at the moment with respect to economic policy and monetary policy. We saw last year quite a strong reaction in the gold market from the release of the minutes of the December FOMC meeting, at which some of the voting members were inclined to think that the current QE program could be completed before the end of 2013, and that caused quite a bearish reaction in gold for 48 hours or so. We think that environment is likely to become a bit more constructive or positive for gold running into the period late February, when we are going to see a lot of intense discussion in the US over the debt ceiling and how that is going to be resolved. That should be positive for gold. At the same time, the physical markets right now have started the year in strong fashion. India in particular, we've seen very good buying so far in 2013 due to a combination of lower domestic prices as well as concerns by local buyers about possible increase in import duties on gold. We've seen demand from elsewhere in Asia. China notably also has been pretty good so far, and you would expect to see that from a seasonal point of view at this time of year in the weeks leading up to the Chinese New Year holiday.
Some investors are concerned that global economic growth will slow over the coming months, and therefore an inevitable surge in prices will diminish demand. But what are your thoughts?
We think the global economy is likely to continue its path of slow and steady improvement this year. We expect the pace of growth to pick up a little bit more through the second half of this year, and that should benefit the white precious metals, particularly the platinum group metals, as well as base metals more than gold. And so looking forward to the back end of this year, the fourth quarter, we would expect to see platinum, for example, trading at a premium to gold consistently by the time we get to the end of the year.
2012 seemed to be the year of central bank stimulus. Many investors have expressed concern that an end to QE would lead to reduced commodity prices. Do you believe that people are selling with the perception that the US Federal Reserve's so-called unlimited bond buying program is coming to an end?
Well, I think in 2013 we're going to see a lot closer linkage between commodity prices and the underlying fundamentals of each commodity. In other words, we expect to see more divergence amongst the commodity asset class. As far as precious metals are concerned, certainly we've seen bond yields, especially in the United States, rising over the last few weeks as growth expectations there have improved. And in general, then we've seen a reduced demand for safe haven assets. That typically is bearish for gold, but we think in the short term we may well see that turnaround, bonds rally again in the US and yields come down again as we get towards those discussions about the debt ceiling in the United States.
Tom, it has been a pleasure speaking to you. Thank you very much for your insights. Well, that's all for today's Commodities Corner. The TV team will have the next instalment for you on Thursday, so please do stay tuned. Bye for now.